Okay.
Yes, sir.
Can you all see my screen?
Yes, sir.
Yes, sir.
Yeah. So type of financial intermediaries, I believe you all will be able to see.
Yes, sir.
Okay, fine. So yesterday we had some problem in internet. That's why we had to stop our discussion before our scheduled time. So for internet, better internet connectivity, what I'll do, I'll keep my video off because we got some suggestion to keep video off so that voice and other modulations are going to be done perfectly. So I'll be keeping off, and before we start today's session, if you have any question based on our yesterday's discussion, I would like to take all those questions, and then we will move forward. Yeah, and any question? Fine. So today we will quickly complete our discussion on financial system, and then we will start new topic on interest rate. Basically, what is interest rate, how we can use, and what are various determinants of interest rate, because that is the important part of any financial system, whether when we talk about our return or when we talk about our expectation. Interest rates are a key factor or proxy, you can call. So I assume that there are no questions, no doubts so far. So with that assumption, we will continue our today's discussion. So and anyway, we will be keep this in mind that we will again come back in our subsequent sessions and discuss all these intermediaries and functioning in detail. So, but these are basically part of financial system. So we should know quickly that what these financial systems are and how they, integrate borrower or fund, have in individual or institution having fund with the person or in institution that is looking for fund. So so in terms of intermediaries, mutual fund, I assume that more or less you all will be aware of. So what they do, they collect they collect money from different individuals. So and then it is invested in certain kind of assets, and based on your choice whether you want to invest in equity or you want to invest in debt, you can select mutual fund. So basically what mutual fund will be doing, mutual fund manager will be there. Manager is going to take care of your money, and then manager will be investing in certain assets. So it means in mutual fund there will be certain charges, service charges you can call related to your mutual fund. That is basically the service that mutual fund house is providing to you, because certain individual or team is allocated. So this is how mutual fund basically what they are doing. They are collecting money from individual, and that money is going to be invested in certain assets. Insurance companies, if you take any insurance, so what basically we do, we considering the risk of certain thing. Let's say when we take insurance of health. So what we are assuming, because health may have some kind of risk, considering your risk and considering the value. Why I am saying value? Because there are variety of health insurance. So even we are not sure about this risk, whether you will be falling sick or there may be some major health issue. But with that notion or with that perceived risk, we go and buy health insurance. Or there are a number of insurance we can talk about, but when we consider health insurance, it becomes very easy. And also value, and value depend upon how you perceive your life, how you think, what kind of working environment you are working. If you are working in a labor intensive industry, then of course risk is high, and then you may prefer to go for insurance, health insurance, which give large high protection, and again for that you will be paying certain kind of premium, and that premium will be function of your value, and that value will be function of how much risk do you consider to your life. Investment banks, in primary market, we have seen that investment banks basically they help companies in borrowing or in IPO issue. They give various kind of services, and that's why these are basically a intermediary. They help both the parties in certain ways. Leasing companies, because we have in our discussion we have seen that one way for company to get get an access to particular let's say here you have a firm company, and company require, let's say, to buy one machinery. So if company wants to buy this, so there are two options. One option, a company buy it by paying certain dollar, or what company can do, company can take help of a leasing company, and this leasing company will buy this machinery, and this machinery is going to be used by this company. So what is happening, rather than paying this much amount to buy this machinery, this company is taking help of this leasing company. Leasing company is buying machinery and then giving machinery to this company for using it, and then subsequently once based on the contract, money will be paid by this company in certain ways. So this is another arrangement. So what is happening, rather than directly raising capital through lease agreement, this entire asset acquisition is going to take place. Mortgage bank. In India, we don't have a very formal way, but you can now in US and other developed market, mortgage market is very strong. So they, based on the mortgage, they classify mortgage into various classes. We call it tranches, and these are, because these are going to be used as an asset, and instruments are issued. So we will talk whenever we talk about mortgage market. And of course, pension fund, basically pension fund, or you can, in India, you can talk about NPS. So basically what these funds are doing, they are getting money, it is being invested in certain ways, and then the beneficiary or the person who is contributing his or her interest is taken care by these pension funds, so that post retirement they will be able to live their life comfortably. And these instruments, of course, instruments are required. Without those instruments, intermediary cannot help. In all these cases we have seen. So we will talk about later about these. So one challenge which is always there about in financial system is designing the financial product. It means, because in financial whenever we talk about financial product, you have two parties. One is issuer. Issuer means we can consider about that company was looking for capital. So what company has done, company has gone to market and then contacted investment bank. Investment bank help company in issuing IPOs. And at the same time, you have a person who is providing these capital, issuer, company, and then you have person who is providing fund. So it means the product should take care of the person who is using the capital and the person who is providing the capital. It means the consideration of both the parties should be taken care of whenever products are designed. So when we talk about issuers consideration, the taxation part, because it is going to be when especially when we talk about debt instrument, it is a liability for the firm. And also there are various tax implications. So we won't go into accounting part, but issuer, may have, certain tax liabilities of the company. And that's why, there should be, some kind of consideration whenever we talk about, taxation. Second is leverage part. You consider a scenario where company is issuing bonds. So here company exists, and what company is doing for raising capital, company has issued bond or debenture. So what we basically, debenture is a kind of debt, or you can call a loan. So company must consider the level of leverage. When we say leverage, we are calling it basically level of debt level in a company. So if company keep on issuing debenture or bond for raising capital, it means adding more and more loan or more and more debt in the company's balance sheet. And if more debt is there, if you have taken more loan, you will be paying more interest on loan. And when it is maturing, you will have to pay principal amount. So it means this is going to be your liability. So if company keep on issuing bond or debt instrument, these kind of liability will keep on increasing. It means company is getting more and more riskier, because whatever profit company will make, first profit will be used for paying all these liabilities. And once it is paid, then whatever residual amount would be left, that will be used, that profit, residual profit will be, going to be distributed among the equity holder or shareholder of the company. So leverage is another consideration whenever, instruments are issued. Then dilution of control. So rather than going for equity, you consider a case where company is issuing equity or shares. And as you know, shares are basically kind of ownership. So when you buy, let's say 10% of share in a company, we will call, that we call ownership, you will have is around of 10% in same company. So it means if company keep on diluting their control or keep on issuing their share, then ultimately company is basically diluting the control. So, and that can also have, implication on the company. And also, as I said, in case of, large debt in the balance sheet, it will impact the cash flow, because ultimately, these liabilities in terms of, interest payment and paying back the principal amount will be there for the company. So these things must be considered whenever issuer is, considering. Apart from this, how much money will be required or how much transaction cost will be there when company go and issue, debenture or debt instrument or equity. Because remember, for issuing equity, company will have to take help of investment bank. Certain additional payment would be required. So additional payment company will have to make, because it's long exercise. additional payment. So this is basically nothing but the transaction cost of issuing equity or share. And same way, when company is going for debt, certain transaction costs will be involved. So that transaction cost is important because let's say company wants to raise 10 million US dollar by issuing, debt instrument or debenture. So, but while issuing, it costs company around 1 million. Hypothetically, if we assume. So initially, company thought that company will raise 10 million, but transaction cost itself is 10 million. So effectively, company is left with only 9 million. So assume a case that company was thinking to buy one kind of asset of. So here company asset, you can talk about a machinery or something. Asset cost was 10 million. So company thought that why not to go for issuing bond or debenture, assuming that 10 million would be sufficient, but transaction cost has reduced 10 million into effectively 9 million. Now company is again, short of 1 million if wants to go and buy this asset. So that's why transaction cost is, one of the key factor. Quantum of fund, how much fund company wants to raise, maturity plan, because you can think about a scenario where company has, issued bond for, let's say 20 years. And every year based on the term and condition, company will be paying certain amount here to the bondholder. So certain dollar value will be paid here. And when it is, because bond is issued here, it is going to mature in 20 years. After 20 years, how company is going to, return the principal amount to the shareholder. So that maturity plan is also taken into consideration whenever issuer is going to, issue some kind of instrument. Apart from that, market condition, what kind of investor company is targeting. Investor, as we have seen, we can classify into various financial FIIs, foreign institutional investor or large investor, and then retail investor. So if we keep two category. So if company is looking for this kind of investor or whether company is looking for this kind of investor, that is also a kind of consideration. And then how company has performed. If company has not done well, then it is going to be challenging for the company to raise target amount. So that's why performance of company of issuer is also important. Cost of fund. So what we mean by cost of fund, basically how much interest or how much you can call cost will be for given level of fund. So for example, if company takes two options, so that so company having two options, company can go for loan or company can go and issue debenture. So when company is approaching to the bank says that you can get 10% annual interest rate basis. Then if company is also considering debenture. So in case of debenture, there will be assuming that I won't go into detail about debenture based on the coupon payment and other as the effective cost for the company about this. It comes, let's say 8% plus something else. Something else, why? Because 8% basically I'm talking about coupon payment, coupon rate on issued debenture, and then principal amount, whatever principal amount is there. So if we consider this, it comes around 11%, because assuming that this as well over the period of time. So in this case, the cost of loan is 10%, and when company try for issuing debenture, it comes to 11%. So basically, these two are costs when company decide to go for debt issue, either with the loan or by issuing the debenture. So this is what we are referring as cost of fund. And of course, regulatory part, what kind of environment is there, whether SEBI or regulatory body will allow company to go for issuing equity or debt instrument. That is also a kind of consideration whenever we talk about new instrument. And of course, as an investor, we can easily relate. As an investor, we are more worried what kind of risk you will have if you go for buy equity or if you go for buy a bond. So let's say equity and debt instrument. So what kind of risk you will be bearing? That as an investor, you should know. Second part is liquidity, because let's say you have 10,000 shares of a company. So these many shares you have. And when we talk about liquidity, liquidity means how easy to trade, or why I'm saying trade, you can buy or sell. So that's why buy or sell. So how easily you can buy or sell your instrument, because when you, let's say, if you are holding this asset and assuming that each share is of worth 100, so 100 into 10,000 is going to be the value of your asset. And even if you need cash, because this is in terms of share, if you need cash and when you are selling, you are not able to sell all 10,000, it means market is illiquid. It means there is a problem. When you wanted to convert your asset into cash, market is not effective enough, or there is no buyer on the other side for this asset or this share that you are holding. So we call it illiquid. So liquidity, whether you will be able to convert your asset into cash and cash into asset, that flexibility is there or not. And that will only be there if company is trustworthy, people or investor do prefer to trade very often, and market is effective enough to provide facilitate. Then return, so how much return your your investment will give. Tax planning, there are various instruments where you can get tax benefit. So whether tax coverage is there or not, so that you will also consider, because tax is the one of the major consideration whenever we decide any investment. For example, on capital gain, you have certain taxes. If you are getting dividend, on dividend you have different type of taxation. Similarly, when we talk about personal income, for personal income based on your income slab, there are various tax implications and tax rates. It means as an investor, you must consider your tax part as well. And then cash flow. Why cash flow? Because there could be certain requirements. For example, if you are low in, you are an investor who prefers some kind of income every year. So here, every year, if you want, this is nth time period, and you are an investor who prefers some amount here at every year or at regular time basis, then you need to select instrument that can have this kind of cash flow. Or there could be another kind of investor who are not worried about these intermediate cash flow, but they are worried about after 5 year or 10 year down the line, how much they will be getting. So here you can see, based on the cash flow requirement, based on the investors' cash flow preference, the investment or asset will be different. So here what investor is looking at after enough time period, how much will be my investment value, and here after enough time period, how frequent or how regularly you can get, or investor can get some kind of cash inflow in terms of certain payoff. So that's why that is consideration. And finally, the simplicity. Many times you will find certain assets are complex. Why complex? Because at the end, investor should know how much return particular asset class will give. If asset is very complex and difficult for investor to gauge their value of investment, then it becomes difficult to find investor for those assets. So that's why simplicity is another factor that should be taken care of. So this is what overall, if you remember how we have looked at, we talk about financial system so far, and then in financial system we talk about various components. Then we talk about type of consideration. Why consideration? Because when instruments are designed, these should be taken care of, and various interaction in sense that primary market and secondary market example we have seen, and how interaction between intermediary with the issuer with the investor, the financial system can help. So this is what we should know in financial system, and as gradually we discuss other subsequent topics, you will find that more or less entire thing in detail will be covering throughout this semester. Do you have any question, or we can move forward for another topic? Is there any question?
Sir, would
Yeah.
debentures be covered in more detail later in the course?
Yes, Samik. Yeah.
Yes, sir, I didn't quite understand the concept of debentures. So would it be covered later in the course?
Yes. Actually, after the discussion on interest rate, I'll be discussing about equity, debt, and what kind of relationship exists. So I'll be covering.
Okay, sir.
Yeah. So this is overall what we will be discussing throughout the semester. So this is what we have just now covered. Now we will go in each topic and try to see what are the various implications. So so what is interest rate? Can anybody say, anybody discuss about interest rate? What do you think and why it is important? Anyone?
So we can regard interest rate as cost of money.
Interest rate as?
Cost of money.
Okay. So why
Cost
you
of
said
fund.
so?
Sir, because let's say from a bank I take a loan. So
Okay.
the cost I am paying is the interest rate. Similarly, the interest rate for any repo transaction, anything, is the same.
Right. Any other way can we define interest rate? Anyone? He is very close. What he is saying, that whenever we go and let's say bank example we take, whenever we go to the bank and ask for a student loan, because many of you might have taken. So when you are taking interest loan, there will be certain conditions. Or personal loan, there will be certain condition. Condition may be, let's say for personal loan, you will be paying 12% interest rate. So this is basically a cost to you. So this is cost of fund, I would say, rather than money, because money is fine, but when we want to put it in more broad way, we should use fund. So basically, this is interest rate is a kind of cost of fund. Anything else can we relate interest rate with some other definition?
It's an incentive the bank gives you so that you deposit money there.
Okay, so you are saying this is a kind of incentive. Okay, good. So
Sir,
this is
it is the extra money that you have to pay for the depreciating value of rupees or any currency.
how can you explain?
Since the amount of substance, let's say 1 kg of sugar, the amount of 1 kg sugar that we could, amount of sugar that we could buy from 10 rupees today would be would be more than compared to 10 years after. So the thing constant is the amount of sugar. So the bank tries to extract the same amount of sugar, uh, uh, so it tries to make us pay more so that it
Okay.
can.
So do you not think there are two dimensions? So in your case, you are saying there are two dimensions. One dimension is time, and another dimension is the cost, or I would write cost and then later. So do you not think in your scenario there are two considerations, time as well as cost? Because what you are saying, the value of money today versus value of money 5 years down the line, same money will be different. So there are you have two considerations, time and cost.
Yes, sir.
Yeah. So basically, we will also discuss quickly this. We call it time value of money. Time value of money. Basically, in short, we call it TVM. TVM suggests that what is the value of a dollar today and what would be the value of dollar in future. So that relationship we measure through time plus cost, and cost is nothing but interest rate. Yeah. I think one student inflation. Someone has said inflation. Yeah, Paritosh. Yeah, Paritosh, can you explain how inflation is related with interest rate?
Sir, how he was trying to explain like with the example of sugar, like that is inflation only. With time, the value of money depreciates.
Okay, so why depreciate? Inflation can go either way. It can
Yes,
go
sir.
up,
Yes.
it can go down.
Yes, sir.
Your point is valid, and that's why I want to understand why you use inflation, because in interest rate, inflation role is important.
Sir, like I read that when interest rates are increased, then like people want to save more and spend less, so that helps to.
Right. Even when we'll be discussing about functioning of central bank and how central bank controls flow of money, your argument we will be again discussing. Yeah. Anything else? So more or less we are close to what is interest rate. So one way is interest rate is it's a cost of fund. And also interest rate is a kind of opportunity cost. And we will see why I'm saying opportunity cost, because when you are taking, borrowing from the institution or from the bank, it is cost to you. But whenever investing or depositing in or investing in one asset versus not investing in another asset, it's an opportunity cost. And that's why how you look, interest rate, that makes the difference in terms of your explanation. So as you know, already we have seen that interest rate, simplest definition, that we can thought of about interest rate is the cost of fund or cost of borrowing. So basically, we are relating with the banks where when you are going to take loan from the bank, how much it costs to you, or the price paid for rental of fund. Same thing. Rental of the fund means when you are taking fund or borrowing fund from some institution, the cost is nothing but the interest rate. As Paritosh just said, that when interest rates are high, it is a deterrent for the borrower. Why? Because let's say if bank is saying that loan is available at 12%, and and another bank says that loans are available, personal loans are available 6%. It means this bank 1 versus bank 2, assuming that if it is possible, because all banks will have to follow guidelines of RBI, but hypothetically we are assuming. So what we are saying that this bank 1 is creating a hurdle or creating a deterrent for the borrower to come forward for borrowing activity, whereas here bank has kept interest rate low. It means here borrower will definitely approach. Why? Because they see that cost of fund is less. And also when we look from investment point of view, if interest rate is low, it is good because more borrowing activity will take place, assuming that borrowers are corporations or companies. So corporation will be borrowing, and this is they will be investing in production or related to production activity. And if production is good, then ultimately it will reflect in terms of economic growth. If that assumption we are making, it means your interest rate is not only related to the cost of fund, it also works as deterrent, or it also encourage the investment in a given economy. And that's why you see ultimately it will impact to entire economy. So it's not only about the cost, it is about the entire financial system, and at the broader level it is the entire economy, and that economy is basically run or governed by the interest rate. And that's why unless we clearly understand what is interest rate, what exactly determinant of interest rate, we won't be able to appreciate this kind of connection between interest rate to economy, right? So I hope you have understood, and as we move forward, you will have more clarity on this. Now, I know most of you may not be aware of yield or this kind of concept, but before I'm discussing these concepts, I would like to show you this so that when we discuss this concept, you can relate this graph with our understanding. So here, what we have is 10-year bond yield. So basically, what we are saying that Indian government. So here, this is Indian government has issued bond. Why we call it bond? Because when there is when the issuer is safe entity, because there is a guarantee by the bank, we call it bond. Otherwise, when a corporation is issuing, you will find debenture is more commonly used word. So here bond is issued with maturity of 10 years. This is what we should know for time being. It means if it is issued in 2021 April, let's say April 01, assuming that it is going to mature by 2031 March 31st. So this is what we assume that this kind of bond is issued. And why this why yield? Yield basically, whenever we use yield, yield is nothing but you can think about return. So yield is basically a return that 10-year bond will give to their investor if they hold this instrument for 10 years. So it means this is the return this bond will generate for their investor if investor hold this instrument for 10 years up to March 3031. So this is what we are saying, and why it is important. If you look and can you look at this? So this is from 2012 to 2020, almost 10-year data. So what is your observation? Can you connect with this time? So probably it seems this is somewhere or here. This is longer time period and this is shorter time period. So first, what we will do, we will talk about this almost 10-year time period. So what is your observation? What is happening here? Can anybody tell? So probably this is somewhere around 8.2%. So this point. Somewhere it went to 9%. Here it came back to 8%, and right now it is 6 point. So this is today's yield. If you go and see, 6.24% is yield on 10 years in a government bond. So are you getting any hint what kind of pattern we have here? Yeah, anyone? So here, if you see, you will find there is a continuous decline. And if you relate with the interest rate in the bank, interest rates, and if you go and look at interest rate, you will find interest rate keep on falling down. In 2012, if you see, interest rate were high, and right now if you go and look at how much interest rate you will get on your saving account, or if how much interest rate you will be paying if you go for personal loan, you will find a decline. It means this is something, this 10-year bond is something which is relating with the prevailing interest rate. We will discuss more detail from where this curve we are getting. And second thing that we should know here is, let's say when we talk about demand and supply. So and as we said that this yield reflect the return that this 10-year bond will generate for their investor. So here, let's say in this in this scenario, if we go here in March and April, return was as compared to March month, here return is around less than 6%. So what has happened? The return has gone down. So what will happen if return in bond market is going down? So what kind of a strategy investor will perform? Yeah. So remember what will happen if yield here is declining. It means you may observe that people will be switching to equity market or other asset class. And also when interest rates are low, because 10-year yield, this yield is used as a proxy for deciding the interest rate. So what will happen when interest rate, this yield is low, you will find interest rate in the bank will be low, because this is a kind of benchmark for the interest rate. So if interest rates are low and here this instrument is not giving more, people will go and switch their asset class or their portfolio from bond market, which is giving less return, they will switch to equity market. And that's why whenever we talk about, sentiment or about the functioning of particular market, 10-year, government bond is a kind of a gauge or measure about the how market is doing. And that's why it is important to know the relevancy of the government 10-year bond. There are, various maturity bonds, but most of the time, whenever we refer to, sentiment of about market, 10-year bonds are majorly used. So basically, this is a sentiment about given economy. And this is the yield curve.
Sir,
yeah.
Sir, I wanted to discuss one more thing.
Yeah.
Sir, most of the time we know that yield is a function of credit risk and the credibility of the other party.
Yes.
So when
but here we are only, in this case we have only government bond. Yeah.
So sir, in times like in this COVID time, in 2020 when COVID hit, I was thinking the other day about it. But when COVID hit, the yield did not rise. So why was that?
Expectation. If see, as an investor, you think about as an investor. If you are an investor and you see there is no other investment option, right? Because you assume that companies are not able to produce, companies are not able to export. If companies are not able to do their operation properly, profit cannot be generated for sure. It means it is not the right time to invest in equity. So what investor will see? Investor will try to find out less risky investment. And if there is no change in the perception about the instrument, then you will find a kind of flat variation, less variation in the yield curve. Are you getting my point?
Yes, sir, I'm getting. But
yes.
In 2008 and 2009, the yield rose sharply.
Yes. Even I'll tell you one more thing. If you go and look at because I'll just give you a hint. I won't discuss here it right now. If you go GSAP, basically G stand for government, S stand for security, A stand for acquisition, P stand for program. So basically, what has done RBI? RBI is purchasing, government security. GSEC is started a program of purchasing government security of rupee 1 trillion in every quarter. 1 trillion. So this is started in April month. Here you see probably. So here you see this is the time period when this is started from April 4 I believe, first week of April. This buying of these instruments, government security, is being done by the RBI. So what we are observing here, what is happening when purchase of government securities is starting? What is happening to the yield? Yield is basically declining. Why it is declining? So if you think about supply of certain asset in the market, and here it is other way, it is reducing. So that's why 10-year bond, these are, so I say I'm not discussing much about this, but this is a kind of macro event which is reflecting in terms of yield of 10-year government security. So whenever we cover, so that's why this is a trigger for you. You keep thinking about 10-year security bond, what is the yield? once we complete our discussion on bond, again I'll come back to this slide and discuss why this kind of movement we observe and how these yields can be used as a proxy for various activities, proxy for risk-free interest rate, or proxy for market sentiment, proxy for investor perception about the market. So all those things we'll be talking about. But for time being, you try to read more about 10-year the 10-year government security and how these can be used as a proxy for various economic indicators. So we will come back, don't worry, but this is what this is a trigger for you. And after our discussion, when we come back, then you will be able to answer most of these questions. And this is yield curve, and these are the various maturity instruments. So we will also see that why we have this kind of upward slope yield curve. Basically, what for time being I can tell you here. So this is the return 2-year maturity instrument, government security or bond, government bond will generate. So what we are seeing, that 2-year bond will generate around 4+% return, whereas when we compare around 10-year, it is 6.24%. So what we are saying that here we are saying as you invest on high maturity instrument, and these instruments are issued by the government. That's why there is very probability of default is very less, that government won't honor their own instrument. So what we are saying, as maturity is increasing, the return, expected return or yield on this kind of bond is higher. Why? And reason you can easily see that if you are if this is your money, and if you are investing this money for 2 years versus when you are investing this money for 10 years, because your money is going to be tied for 10 years, you will expect more return. And that's why in normal scenario, what we see that as maturity period increases, you expect high return, and these instruments should give high return. Otherwise, people may not come forward and invest. So this is what how we should look at. But once we complete our discussion, you will be able to further appreciate these relationships. Now this is relationship or a graph that talks about real interest rate. Real interest rate, basically inflation adjusted interest rate. So what is real interest rate? Real interest rate is nominal interest rate. We will talk about Fisher theorem tomorrow. Nominal interest rate minus inflation. It means when you subtract inflation from nominal interest rate, what we get is real interest rate. So what we are as saying that for saving bank account, basically these saving rates are top 5 banks rate. Top 5 bank rate. I got this from RBI website. They have not updated. That's why only up to 2010 data I could get this graph. So what we are observing that on an average, when we look at this green graph, on an average, based on the inflation rate, your saving, even in certain cases, if you see here, especially here, your saving in the bank deposit was negative. Why negative? Because it has not given much return to compensate the inflation rate. Only around this period, you will find positive return if you would have deposited your money in the bank. It means, of course, whatever return we observe in the bank or in the market, it is giving some positive return. But unless we adjust it for the inflation, we cannot decide whether your investment is going to give you a positive payoff or negative payoff. But in this case, more or less what we are seeing, that whether you deposit in government security or you deposit in 1 year government security or short-term money market instrument, in all three scenario, all three type of investment option, more or less your return is going to be negative. So that's why understanding of real interest rate and role of inflation is important. So what we will do, we will stop our discussion up to this point, and tomorrow onwards, we will talk about why interest rate moves, what are the various reasons, and then ultimately we will cover bond market and equity market, how we deal or how we evaluate those instruments. Because at the end, you as an investor, you are going to consider investment in bond, in equity or some other instrument. So we will also spend some time to understand role of interest rate when we talk about equity, when we talk about bond, and how we can evaluate those instruments. So basically bond valuation and equity valuation we will be doing in subsequent session. So if you have any question, I would like to take. Otherwise, we will meet tomorrow and try to further explore interest rate topic in detail. Yeah. And any question?
Sir?
Yeah.
In the previous slide.
Yeah.
So why this? No, not this one. This one. Yeah.
Yeah.
Why this curve is just flattening after for 20 years?
So it depends upon the expectation. See, I'll tell you, because whenever these rates are decided based on certain assumptions. I'll give you, let's say you have two instruments. One bond is maturing in 10 years, another bond is maturing in 30 years. And this bond is going to give you, let's say 10 year 6%. When we talk about coupon, for time being, just do coupon rate and paid semi-annual. It means every 6 months you will get half of 6% interest rate. Whereas 30-year bond is going to give you, I'm assuming, let's say 7.2% of in coupon rate, and payment is again semi-annual. Generally, semi-annual payment you will observe in the case of bond. So the reason why we don't see difference, because as an investor, you won't find major difference between 20-year and 30-year. And assume that who will be the investor in this type of instrument? Those investors who want some kind of regular payment. Remember, and considering the current market scenario where on bank saving we hardly get 5%, and if bond can give you 7.2% for around 30 years as a coupon based on the issued instrument, you will be happy. And that's why, based on the perception, you won't find difference. You will find difference between 5-year and 10-year, or 2-year versus 10-year. But as we go for long maturity period, that difference in the perception about the instrument among the investor is low. And who will be investing? As I said, in this instrument, people will be investing who are not very much worried about the final payoff at the end of 30 years, but they are more worried about intermediate payoff from this instrument. And that is the reason we've in most of the cases you will observe a kind of flat curve for a long maturity instrument. You will get your answer whenever we talk about forward rate and how forward rate can be estimated. You will be able to appreciate why this is almost flat for 20 years and up to 30 years.
Okay.
Right? So yeah, you will get answer, but for time being, you assume, you consider scenario that if you are investing in 20-year or 30-year bond, what would be your assumption? Whether you are more worried about the final payment when your bond is going to mature, or you are more worried about the coupon payment of 7+ % that you will be enjoying for almost 30 years. Right? So you don't worry, you will get answer when we discuss all these theories. Fine. So and any other question? If you have any other question, we will take. Otherwise,
Sir,
we will. Yeah.
Sir, in the previous slide,
Right. Yeah.
why the yield has been decreasing over time?
So what could be reason? You tell. You just guess whatever you feel. You guess.
Because more people are moving into share market.
Yes. So this is not only, but there are various reasons. Many times the how government is performing, but basically macro environment. If macro environment is good, you will find a certain trend in terms of yield. And there is here you have asked this question. So there is inverse relationship between price of bond and yield. So I thought of not discussing right now. There is a negative relationship between price of bond and yield. And also you think that if this 10-year government security is an instrument, and if yield in this is going down, what will happen? People will shift to equity market, because they will say that the government bonds is not giving me expected return. I won't mind taking switching my portfolio, and I'll go and invest in some other high return, of course, high risk instrument. And government always try to keep this yield in certain what we call band. And there is a reason, we will see, because if you try to relate the buying of bond here and government's announcement in budget about taking loan of 12 trillion. Remember what is happening here. RBI is purchasing bond, and what government has said, government is going to in 2022 government said that I'm going to take more loan. Means government is saying I'm going to issue bond, and here RBI is doing. RBI is buying the government bond. Why it is doing? So that the interest rate, this can be controlled. So it is again debatable whether it is good move or bad, because it will have impact on banking system, on interest rate. It will have and the largely it will impact on entire economy. So we won't go into the deep, but if you think about scenario, one hand RBI is purchasing on behalf of the government bond, at the same time government is saying that we are going to issue new bond and raise 12 trillion of capital or loan from the market, right? So these kind of things are there. So it's not about only one dimension. We can relate this with the equity market, but this is basically tells you the sentiment, how things will move in the coming time periods, right? So we will stop once we discuss this topic, this basically yield, why yield is important, how we can draw yield curve, then you will be able to further connect the these variation in yield curve. Right, so we will continue our discussion from this slide tomorrow and try to better explore interest rate topic. Any other question? Any quick question? If you have, I'll take it. Otherwise, we will meet tomorrow. Yep. Any question? Okay, thank you. So we will meet tomorrow and try to further explore this topic. I am concluding today's session. Thank you.
Thank you, sir.
Thank you,
sir.
Thank you, sir.
Thank you, sir.
Thank you, sir.
Thank you, sir.
Thank you, sir.